Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to Jamie Constable of Singers, one of the UK's finest capital markets experts. So welcome, Jamie.
Hi, Paul. Great to be here again.
Yeah, well, given yesterday's downgrade on global growth expectations by the World Bank down to 2.9%, which I think actually is the second one in a row just this year. So it seems to be getting to a bit of a trend. What's your sort of like broad outlook for equities going forward?
Well, I think we seem to be in a little bit of a kind of no man's land at the moment. Everyone's waiting to see what happens. You know, whether we're waiting to see what happens with the CPI, whether we're waiting to see what happens with growth. It's very much, you know, what's the EU going to do on rates? Everybody's just waiting for something to happen, and that means that volumes are lower than they have been in markets. And that's not just a UK issue. The States is exactly the same. They're not seeing the volumes, and when you get lower volumes, you get increased volatility. So, I mean, I think as we move through this, what we need to look for is this peak in CPI is going to be the key point. As we said on previous programs, I think it would have been earlier this year, but for what we're seeing on the oil price. I mean, the oil price today is knocking through at $122 a barrel on Brent. It's going to cost us £100 to fill our fuel tank up if you've still got a normal car. I mean, that's hitting consumers big time. And there doesn't seem to be any end in sight to that oil price going up. So that's a big constraint on the consumer. On CPI, when could it peak? Well, we get US CPI this Friday. Last time it dipped back a bit to 8.3. People were a little bit disappointed.
Just on that one, Jamie, how should investors be positioned going into that really sort of like crucial print on Friday?
I'm a little bit worried, to be honest. In May, May on April, so we saw the fuel price, gasoline price in the US fell. So that was a negative in the last print on CPI. Now we're seeing all-time highs again. So that's quite a big blip up again. Used car prices did come off the top. They're now rising again. So if we get CPI, I think it's forecast to fall from about 8.3 to 8.2. If it were to gap up again, I think markets could get a little bit worried. We've seen bond yields just ticking back up to 3% on the 10-year again of late. If it goes up again, I would expect markets to come off on that.
And if you're right, is that because there's going to be more pressure on the Federal Reserve to increase its interest rates, and that'll blow out US Treasuries?
Well, the rally we had in May, if you think back to, was it the second week of May, I think, that was triggered by Powell coming out and saying that, no, we're not looking at 75 basis point rises. And then we've had quite a rally in the markets for large cap. You know, small caps rallied a bit in that period, but large cap, if you look at the FTSE, in the US, we've had quite a rally in equities. If it were to go back to thinking again, we're going to have 75 basis point rise at the next meeting, then I think we could lose that. So there's a risk around this week's number on CPI. Also, tomorrow or Thursday, we're going to get the EU coming out as well with what they're going to do. I mean, rates are still minus 0.5% in Europe. I mean, CPI is 7.4. I mean, it's cloud cuckoo land kind of economics for them. There's a chance they might cut on Thursday. Who knows? But they definitely will cut. Sorry, raise. What am I talking about?
Just going to say cut. I was thinking, crikey, yeah. I've not heard that one.
No, raise on Thursday. Much more likely it'll be in July because they're still doing QE, would you believe, even now. So we've seen some big rises in European yields. I mean, the spread of Italian over German 10-year now is 200 basis points. That's about where it probably should be. But if it were to rise to, say, 300, you would have big questions about what's going on in Europe.
Just coming back to that sort of the CPI on Friday, if you're right, and the actual CPI comes in slightly hotter than expected, sort of like and we do get a bit of a reaction. Where does that position Jerome Powell in terms of the put? He seems to have two competing forces because he's got the US president Joe Biden on his back, saying that's his number one goal is to reduce inflation over and above. He hasn't said this, but probably over and above the economy. But if we do get a hotter than expected, that's going to heap a shed load of pressure on Jerome Powell and the Federal Reserve to respond effectively, hawkishly, more hawkish than even the market's expecting. But equally, you could see a blowout on the actual markets, a drop on the markets because of the higher on the higher CPI, and therefore, you know, so how's Jerome Powell going to position himself? He's got this put thing that he's educated the market along, but now he's got the president on his back.
Yeah, he would, if we get a higher. Now, I'm not saying that could. It's a risk it happens on Friday. If it were, if the market's straight away going to go to, they're going to need to do a 75 basis point rise. So, I mean, it's come back to almost 2 rises, the next 2 meetings of 50 to take them to 200 to 2%. And then question mark, will they do another 50 in September because there isn't an August meeting? It's straight back to you're going to have rates are going higher. Market wouldn't like that, and the market would come off. So it's a risk on Friday. I mean, it's difficult to tell because prices are all moving around all the time. But one thing is very clear: gasoline prices and UK petrol prices and diesel are going up, are hitting new record levels, and that is going to impact on the CPI levels in both economies.
So I'm just going to give you a scenario here, okay? And nobody knows what happens, but the big hinge factor with inflation, and certainly with the crude oil, is Ukraine, Russia. So let's just say they don't actually have a ceasefire for the rest of this year. What does that mean? When will US CPI come back down to the Federal Reserve's 2%?
Well, I mean,
which year?
It stays elevated through to the end of the year, doesn't it? Because I mean, I think kind of if there was a ceasefire and oil and US and Russian oil came back, you'd probably see $20 off the oil price, maybe even more than that. It'd be back below 100 in a flash. But with no ceasefire, it stays elevated, doesn't it? And OPEC are showing no inclination that they want to increase production. They did remember, last week, but all they did was bring forward what they were going to do in September by 2 months. And once people worked that out, the oil price kept ramping up again. And do we now look at, as we move into energy replacement, the electrification of the world and carbon neutral, does the oil price just stay elevated all the way through into that now? Just because why do you bring more production on? Because you're not going to be rewarded. You're going to have a high reward for it because you've got what's your window of production before demand starts falling again. So yeah, it stays elevated. That keeps the CPI up, and that keeps the pressure on rates.
At least for another 12 months, because you'll only start getting the roll off this time next year once it hit. If it stays flat at $120 a barrel, I guess. Yeah. And of course, food's the other one as well, where food inflation's right up there now as well. Yeah. Because of wheat and everything like that. And it's interesting. You speak to companies, and we talked to whether inflation is now kind of becoming embedded in the system. And companies are saying we're putting prices up and it's expected and we're not getting any resistance. Well, that arguably is the definition of it's becoming embedded in the system now, isn't it? And they're not talking 1%, 2%, 3% now. They're talking 5%, 6%, 10% price rises that companies are pushing through. So, yeah, I mean, inflation is back in the system. And now this next thing is what happens with wages. We've just heard it. We're seeing it in the UK now that the power of labour has switched. We've got record vacancies globally, not just in the UK again. You've got record vacancies, unemployment low, margins all-time highs for companies looking back, but looking forward, what's going to flip on that? They're going to have to pay away some of that margin to staff. Because, I mean, if you're offering someone a 0% pay rise, it's okay. Should the railway workers be going out on strike? Probably not. But if you're offering them a 0% pay rise and they're seeing 10% inflation, they're going to they need a rise of some sort, most probably. So, yeah, we're going to have that, and companies' share of profits from record levels we've been at will come back a bit. So then it all comes back to what we've spoken about before, pricing power. You've got to have the pricing power to be able to pass that on
quality companies, quality growth companies is where it will be at. Once we see that CPI rolling over, the first stocks that bounce will be quality growth.
Yeah. And how much is this uncertainty? Let's just assume, and I think you're probably right, actually, inflation's going to be stickier for longer here, because unless we get a
it comes down, it'll come down. I think it will come down and be sticky around 3 to 5%. We're not going back to 0 to 1 again. Sorry, I interrupt. Beg on.
No. And also, I think the time it takes is going to be at least another 6 months, 12 months further than the markets, well, further than the bond yields are expecting. Now, with equities, though, they've come down a lot. And what we've seen of late is a lot of very small caps, but certainly large caps as well, that they've had bad news. And actually, they've gone down slightly on the day on the news, but ended up the day slightly higher. Nvidia, for instance, but many small caps, and certainly in my portfolio. So the big $64 million question is, a lot of this uncertainty, has it already been sort of like baked into share prices and valuations?
Certain areas of the market, I think, yes. I'll start with the areas I'm less confident about. I'm less confident about the consumer space, particularly in the UK. Target in the US now have had 2 profit warnings in 3 weeks. That's pretty good going to get 2 out in 3 weeks. They didn't fall much on the second profit warning. They fell a lot on the first. You had the B&M warning in the UK the other week. That's fallen and it's kept falling. So often it's the third profit warning. You say, profit warnings come in threes, is an old adage in the market. First couple of shares fall. The third, what you're looking for is when shares bounce, which I'm sure is what you're alluding to. Shares bounce on the profit warning because people are looking through that to the upturn. I think in the consumer space in the UK, we've not really seen the warnings yet. So I'm still cautious on the consumer space in the UK. There's been very much a change in where people are spending. RMI, housing, household, the house, that's been what people have spent on for the last 2 years during the lockdown and the pandemic. You can only buy so many sets of garden furniture, etc. And now if you go to buy one now, it's probably 20, 30% more than it was last year as well. So I think that area starts to suffer. High ticket starts to suffer. You can't buy a car at the moment if you wanted to anyway. It's down 20% on last year's low number, the new car sales figure for last week. So I think the high ticket is stuff is where people are spending at the moment. Obviously, there's been a big spend on the Jubilee. The question at the moment is that the last hurrah of this consumer in the UK? They've been spending on clothing a bit because they're going out more, they're going back to work, they're going on holiday. And they've been spending a bit on restaurants and pubs and stuff like that. Fulham Shaw, good announcement today. That's low ticket, though, remember that. At Fulham Shaw, you go in there and have a pizza and a beer for £10. So that's good low ticket stuff. But we've had, other than that, we've downgraded our numbers on Marston's restaurant group. We've had to downgrade numbers on those, but Fulham Shaw much better because it's that lower ticket, I think. So consumer, still cautious. I don't think we've had all the warnings yet. But that quality growth area of the market, plus differentiated secular growth kind of areas, yes, particularly in the small and the mid cap, we see shares have been really thrown the baby out with the bathwater, as it were. Share prices have been hammered. They've come off a lot. As institutions have seen redemptions on their funds and things like that. And at the end of the day, you have to sell your good stuff in the end, because if you're seeing money going out, because otherwise it just becomes a bigger and bigger part of your portfolio. So, and the retail investor, let's be honest, hasn't been playing that hard either in the last couple of months. So yes, there are stocks that have been hit hard. And
so which ones do you like then, Jamie?
Well, I think we can maybe pat ourselves on the back a little bit first. Stocks like FRP, and you had Begbies and
Manolete, what I had, and then you had Begbies, I think was the other one.
And FRP, they've all done well. And
just for the investors, that's the insolvency play, counter-cyclical, and they've recovered strongly. I think Manolete was gone from 230 to 330 today as well, but it's actually still reasonably valued.
No, I agree. All those stocks, I think there's more to go on those stocks. They're buying in anticipation of bad news from the economy, I suppose, but good news for them. So it's still like those. There's other stocks, Eneraqua, which I mentioned last time. They've got results next week, I think. What's that? That's a differentiated play on decarbonisation, taking out 40-year-old energy systems in multi-occupancy blocks, putting in new 40 to 45% saving for the tenants.
Well, these heat pumps, aren't they? Heat pumps
it's
water systems.
It's water systems and heating systems, yeah, and making them very efficient rather than extremely inefficient. So that still like that one. Yeah, it's looking for those differentiated plays. You had Calnex numbers, which you talked about. This is the synchronization into data centers and data.
This is 5G play.
5G, yeah. Now you're paying up for that. Let's be honest. You're paying a 30 times multiple for that. But we would expect to see upgrades this year. So it's finding those differentiated stocks like that, where you've got secular growth. Secular growth is an area you want to look at now. So they've got that underlying growth, whatever happens with the economy, that can drive them forward. The other one's infrastructure. We've mentioned it probably in almost every call in the past, even though the government seems to be kind of chopping bits off HS2 every other, one bit by bit. That's still happening, and companies are benefiting from it. The likes of the Begbies, the speedy hires. They're still that work is going on. That work is being built. AMP4's happening. AMP7's happening on water. You've got rail, Trans-Pennine route being done for rail. Those things are happening, and that's benefiting those companies. So
I would agree with you. I think certainly on the infrastructure side, there's a company that I think Gervais Williams introduced me to, Hercules Site Services, which is trading on about 11 times, and that's well in bed with the sort of HS2 and supplies all the a lot of the headcount into it. So it's got huge visibility. And another one which actually just won which is a secular grower and a bit of an infrastructure stock or asset play, is One Spatial, which is only a small cap stock. And I mean, it's still very cheap. I can't remember exactly what it's on. I think it's on about less than 2 times sales for a tech stock that's got a big footprint out into the States with lots of recurring revenue streams, so high, sort of like EBITDA drop through.
Google as a customer in the States. I mean,
and another one, and
it can't be too bad if you got Google as a customer.
Yeah, I mean, one I've recently bought is activeops, which is it's basically a work process automation business, really for the financial community and banks and insurance companies, that helps you manage effectively resource capacity load and manage people when it's on a hybrid, work situation. So in the office, working at home. And they do all kinds of stuff in terms of helping people improve that sort of whole productivity, which will be crucial. And I think that, again, they're on less than 2 times sales for a high quality recurring revenue stream tech software business. So it's choosing your spots, isn't it?
It's a bit like they're a bit like Gresham Technology as well. They're selling to the same type of customers, and Gresham Technology, a global leader in their field, as you can see from the tier 1 bank contracts they keep winning. So there's companies out there, and it's looking for the opportunity in these volatile markets that we've got, that you can tuck those companies away and go right, and then on a 2, 3, 4 whatever year view, you're making good money. So another one I quite like, we saw recently, was MPAC. A nice niche. Our regular listeners will know that I like capex driven stocks at the moment, reshoring, nearshoring, 15 years of underinvestment in the global economy. Well, what do? They do packaging systems. They provide the systems. So as people...
It's machinery, isn't it? It's manufacturing machinery.
Yeah.
CEO is Tony Steels, I believe.
Yeah. And you've got a little kind of optionality in there, because they're doing this pilot battery line in Scandinavia for actually manufacturing of EV batteries. And it's not, if that were to succeed and they were to replicate that line, then they could make a lot of money. And there's nothing really in the price for that, because you're paying 11.5 times PE for this stock. If that were to get people to get excited about that, great. I mean, it's a
quality business, that is.
Yeah. So we like that one as well. 11.5 times. You're not paying a silly price for it either. So that's what we're talking about, isn't it? Nice companies, secular growth on cheap valuations.
And what just finally coming full circle, just on the equity markets, what's your sort of outlook until our next meeting in a month's time, and then the end of the year?
Let's see what happens Friday. I mean, it'll probably be a non-event. Let's be honest; it'll probably come in, and we won't. But
you sound quite cautious, then, don't you? I mean, you're playing defensive, which makes a lot of sense given what we've just discussed.
Yeah, CPI is not going to come down rapidly. The UK market, in particular, you've now got this political risk right back in there again. Because who knows what happens in terms of who's going to lead the Conservative Party or whatever. But for external investors, i.e. overseas investors looking at that, it doesn't look too wonderful to them, does it? As we've seen with sterling. I mean, sterling right back again. And what are we, 116 something against the euro, 125 against the dollar? We're right down there. I mean, there's some of the big banks have come out saying, is the sterling starting to behave like an emerging market currency, which, God forbid, we don't want that to happen. But make those overseas holidays look a little bit more expensive if that were to happen, if they aren't already. But yeah, I mean, you've got to be a bit cautious because of that. But I think once we get through that CPI peaking, in coming back down to a, say, sub 5% level, bonds will come up. What will bonds yield then? 3%, 2.5%. I think equities will look very attractive again then. So now's the time to be looking for those opportunities to put stocks on the portfolio for when that happens.
If you're right, and they do get a 5% sort of underlying level of CPI, though, bonds are going to minimum. It's going to have a negative. Sorry, maximum you're going to accept is a 1% negative yield. So they've got to be 4%. Plus.
Yeah, they'll be 4. I think probably the range. Well, the reason why I'm saying around there is the range will be 3 to 5. So something like that. I don't know how low we go. Again, it depends what happens at oil price, doesn't it? But then you get the annualization effects as the last year's numbers drop out. So there's a lot of moving parts at the moment, whether it's Ukraine for food, oil. There's a lot of moving parts in that CPI number at the moment. But what we are hearing, which is a little bit encouraging, is that if you look at the auto space and heavy trucks, and they're starting to say that availability of chips is improving. Now that's good news. That could take quite a bit of inflation out of the system if that were to happen. So it has to improve in the end. China's opening up again. We shouldn't forget that as well. So that's going to help as well, because the production from there will be coming back again. One thing to watch on that, actually, before we finish, is actually let's see what happens to freight rates again, because obviously freight rates have come off the top because China shut down effectively with COVID. Will they go back up again as China opens up again? So we'll have to keep a close eye on that. But Target was in I think the reason why I mentioned the Target profit warning, the second one earlier in the call, was that one they said they're overstocked and they're going to discount to get rid of those excess stocks. So maybe we won't see that big leap in demand we saw when we saw the first opening up, which drove obviously freight rates to extreme levels. And that would be, again, good for business, because that would take that pressure off inflation again.
And then just finally then, in terms of the Federal Reserve, because it seems to be the main sort of like pivot point here.
It is.
I mean, they've basically made a policy mistake being transitory inflation and super dovish. Is it going to be a policy mistake and they're going to be too aggressive because the US president's on their back?
I don't think there'll be that. I know. I think they're so far behind the curve. They've got a lot of catching up to do first before they go too aggressive. I don't think so. They can adjust so quickly on a month because they have the meetings at such a regular time. They can move quite quickly on that. I think then it's harder for them to make a policy mistake the other way, I think, by going too far too fast, because they're doing 50 points. I don't see that happening. The big question that people are asking themselves now is, what did that first rate rise, the May rate rise, did that stop the economy dead in the States and arguably in the UK as well? And that's what we're waiting for the answer for at the moment. And I think it's the Q2 earnings season, as we're already starting to see with the likes of Target and Walmart, etc. Is going to be very interesting to see what companies say about demand. Has it kept going?
Oh, good. Well, in that case, let's finish on that positive note then. So he's not going to drop the ball twice. He'll only do it once.
No, it's only once. I think they've learned their lesson. They haven't got that short of memories, hopefully.
Okay. And what's the space for Friday, whatever it is, when the CPI comes out? So thanks a lot, Jamie, and speak to you in a month's time.
Cheers. Thanks, Paul.